So most of the founders and the senior execs that I talk with are carrying the exact same hidden risk. And it's not because they made a bad decision, it's because they built something valuable. Their income comes from one company. A large part of their net worth is also tied up in that same private business or that same single public stock. And whatever sits outside of it usually is in maybe their single family home and ends up in either index funds or mutual funds in the stock market by default. Now, they didn't choose concentration as a strategy. It just kind of happened while they were building their business. And I know this feeling, by the way. I'm a founder too, and for a long time, a huge portion of my own net worth lived in one company. And when things are working, it feels incredible. But when they turn, you feel it everywhere all at once. So there are really two questions worth asking what I'm going to unpack in this video here. One is, first, what happens if too much of your future stays tied to one asset, no matter how good that asset is? And second, if stocks are the default way that you try to diversify that risk, does the risk and reward actually make sense at 2026 prices? And that's where the conversation gets interesting. So stocks are incredible and they're kind of expensive. But let me be clear up front. What we're seeing that's growing the stock market right now, AI and productivity, it's real. The gains are real. The CapEx cycle is real. We have a major backdrop in human productivity advancement in the US and in the entire world driven by AI. And there still may be a lot of room to run for that, and that's going to really help stock valuations. But some analysts are only calling for high single-digit returns this year. And look, that could absolutely happen. You're not crazy to own stocks. I own them too. But here's the part that gets glossed over. At today's valuations, you're paying a lot for each dollar of earnings. Now, roughly speaking, investors right now are paying about $30 for every $1 of annual earnings across the S&P 500 stocks. This is called the price equity ratio, and it's a measure of essentially how valuable things are trading today. So we're, a little bit north of $30 for every dollar of earnings. But over the last decade, a more normal range was closer to the high teens. So we're talking, more than 50% over the sort of the average median of what this range should be. Now, does that mean that things are going to come crashing down tomorrow? Not necessarily, but the people that model this stuff and do this full time, they're really looking at these numbers, estimate that if the US stocks are projected to only return something like high single digits per year from here, you can also look at the same time at what a boring 10-year treasury pays, which is in the mid single digits. So the extra return that you're getting for taking all the volatility of stocks, all the headline risks, all the drawdowns is really only a few percent per year if these analysts are right. Now, does that mean that we should all go sell our portfolios immediately? Absolutely not. But it does mean that for each additional dollar of risk, you're getting paid basically a lot less than you used to for that same amount of risk. And if stocks are part of your broader plan, that's fine. But if they're your only plan outside of your company, this is where things get pretty fragile. Now, meanwhile, something different is happening in real estate. While stocks are pushing towards all-time highs, real estate has gone through something most people have missed. And it hasn't happened in a big headline. It's really just happened quietly. Rates have jumped as of the last several years. Valuations have, started to reset. Equity refinancing has gotten much harder to do. And as a result, there's been a lot less capital going into real estate, which brought some of the prices down. And a lot of owners are currently getting squeezed. Now, on top of that, new construction has dramatically slowed down. And developers are starting to finish what they had in their pipeline and not really starting anything new. So in simple terms, prices have adjusted, supply growth has cut back, demand is still very much there. We're a renter nation. That's not going to change anytime soon. And fear is pretty darn close to an all-time high. And this is why I keep saying the same thing, that the big real estate crash people are waiting for has kind of already happened. It just didn't look like a stock chart slamming into the ground. Now, a lot of smart people push back here and go, well, aren't we going to get a 2008 all over again? And the short answer from my seat is no, not at all. Systemically, things are totally different. 2008 was a banking and mortgage crisis. There were bad loan products given to people who weren't qualified for them that had adjustable rate mortgages that changed pretty quickly. And there was leverage all up and down the chain, people taking bets on bets on bets that really compounded the impact of disruption. But today looks totally different than that. I don't know if you've tried to get a loan anytime recently, but lending is far tighter. Most homeowners have fixed rate debt. A lot of it is pretty low interest rate. But yet we have this real housing shortage. In some cases, people project north of 3 million affordable housing units are missing nationally. Now, it doesn't mean that prices automatically go up, but it does mean that I'm not going to be sitting on the sidelines waiting for some dramatic replay of the Big Short that likely never happens in the first place. So in real estate, really the reset happens through loan maturities, through quiet distress sales, owners that are exiting or mom and pops that are retiring that have owned an asset for a long time, and new supply drying up. And all of that process is largely underway. It's not up for debate. It's already factual. It's already happening. And so real estate looks surprisingly attractive right now. But here's the part that surprises even stock-heavy investors, that in a market where public equities are priced for essentially for perfection, you can find real income at reasonably low prices in real estate today. And it's not in everywhere, it's not in every asset class, not in every market, but in the right markets and the right asset classes, you can buy boring, necessary housing at yields that didn't exist a few years ago that can essentially pay you to wait while the property appreciates. And that gap exists because there's so much fear doing the work for you that isn't there in the public markets. But I would conjure to say, should we actually be more afraid of the public markets with how high they're valued versus real estate with how undervalued it's become? And by the way, when I say real estate, I don't mean everything with a roof. Let's go on a buying frenzy. I'm talking about a couple different segments within real estate, especially. And they're intentionally boring, by the way. One is Class B workforce housing. I'm talking about the Goldilocks of multifamily apartments, not super low income, not ultra luxury, just that kind of, working class American apartment type complexes that can be improved, where it can increase the rents a little bit, force appreciation, and do well owning some good apartment complexes in growing markets. And the second is mobile home parks. I absolutely love this asset class. There's a big stigma around it, which keeps a lot of people out. They're not making any more of them. And yet they're just the pinnacle of affordable housing, where good management can go in, clean up the park, keep a safe, happy, good environment, and ultimately, have an asset that cash flows really steadily as long as you hold it. That's it. This is all I'm talking about here. Homes for normal people, not luxury, not super, super low income, but really just stuff that holds up because people always need a place to live, and affordability matters, especially, by the way, if we ever go into recessions. So when I'm looking at these real estate assets, the market matters. And before we ever even look at a deal or start talking with an operator, we screen the market itself and make sure we're even comfortable to own there. And our market screen looks like everything from considering vacancy rates and new supply to rent growth, population growth, job growth, industry diversity. I don't want everything stacked up in, let's say, one industry. And if that goes into a downturn, we suffer. We're looking at valuation, landlord friendliness, climate risk, which I think is an increasingly important part of our thesis, affordability, and even property tax. And only after a market clears our filters do we start to talk about the specific asset and the sponsor and their track record, the business plan, the valuation, the structure, and all the things that would come into asset-related diligence. So because of this, we say no far more than we say yes. And that discipline is exactly why founders and operators with real net worth care about the process and the details and make sure that, who they're investing with really knows what they're doing and they can see the angles and focus on, protecting the downside first. But ultimately, is real estate still expensive, right? I mean, these are big asset complexes. Some of them are 10 or 20 million dollar apartment complexes. Isn't that pricey just like stocks? Well, in 2021 and 2022, I probably would have said yes. People were paying essentially growth stock prices for apartment buildings, and cheap debt made bad decisions look smart. But today's different than that too. The valuation around cap rates, which is effectively how you value multifamily, have moved up. So it's gotten basically cheaper to acquire assets. Debt costs are starting to get much more moderate. I know people that are pricing rates right now around 5% or even a little bit lower. And underwriting is far more conservative. I mean, some of the things we're looking at have 0% rent growth. And you can buy income again. Is it cheap? Not always, but in many markets, it's pretty fair. And it's a pretty good measure of value, especially relative to where stocks are right now. So for a lot of the high net worth and the ultra high net worth founders I work with, fair pricing in boring assets beats everything out of rich pricing on super crowded trades. And, the line again that I hear all the time, I'm waiting for the big crash. I hear it, just probably once or twice a week. Real estate typically does not give you a clean bottom. It moves through the spreadsheets, not really the headlines, and it takes time. The people buying today aren't really trying to time the exact low. We just know that we're in it. And we're buying from sellers who have real pressure and limited options. We know what it costs to make these assets new today. And in many cases, it's more than 50% what it costs to buy them. So that's a window that doesn't stay open forever, especially when there's so much valuation baked in to stocks. So why does this matter if you're super concentrated in your company and maybe you have a little bit of stock exposure? Look, I want to be clear. I am not anti-stock. I own them myself, but I refuse to let the default story control my financial life and my investing. That you have to just book it into stocks, and that's how you grow your wealth. The founders and executives that I work with, they're not abandoning their equities, but they are rebalancing their risk, and they tend to carve off a pretty good slice of what might otherwise be in stocks and bonds and move them into boring, tax-efficient cash flow, of which real estate and private credit really offer some interesting avenues. And then their job, it's still tied to one story. Their stock still tied to that story, but their long-term wealth is not. That's tied to durability. And that shift lowers stress. It gives them control. It gives them options. So if most of your net worth is really at work in one company and you feel that tension, just know that you're not alone. I work with people like that every day, and I've been in that exact place myself. And, the setup that I see again and again when I talk to founders, operators, execs, is that this is how they've built their financial future, which is fine. But if you want a neutral second set of eyes on how you can actually balance the risk of sort of over concentration exposure with real assets that kick off real income that probably aren't going to crash, through the floor, I'm happy to have the conversation with you, create whatever clarity I can. Don't hesitate to look us up, www.oceanridgecap.com. Love to hear from you.